you look at the current state of the industry outside of Bitcoin, there's still very much people that are hanging on to this idea that you can actually scale blockchains naturally at the base layer. What I've been saying all along, very much lately actually, and even in Riga when we first met, was that this notion always that Bitcoin is the internet of money, but really Lightning is the internet of money. Because Lightning, just like the internet, has the issue that, systems, again, like Ethereum are having right now is, so again, the permissionless aspect is the major breakthrough and the major difference here.
We're 50 minutes in and we haven't talked about ARC, so that's why I want to bring in ARC now, and really ask you, what is ARC?
So I will say to start off that ARC is compatible with Lightning. There's actually kind of like a very great synergy between both systems, but ARC is a little more, I would say, closer to the Bitcoin main chain in some ways than Lightning is. What I mean by that is really that ARC is...
Alex Bergeron is driving Bitcoin scalability with the ARC protocol. His insights have been cited by BitMEX and featured in Bitcoin magazine.
Where used to work as a journalist, exploring topics around Bitcoin's tech and its geopolitical impact.
There's an opportunity for ARC to become a bit more of an execution layer. And that execution layer allows you to create sort of the types of contracts that would not be cost effective to create on-chain. Bitcoin does have scripting capabilities, and you're able to create kind of like rudimentary contracts on the Bitcoin blockchain on-chain. The problem is you're constrained by space and time. What ARC potentially allows you to do is remove those constraints and therefore execute sort of like higher level contracts that are tied to ARC virtual UTXOs, and eventually
it can sort of enable what's called Bitcoin native capital markets. Concretely speaking, what would be possible then?
One of the things that we're looking at is, for example, there's a lot of things that are happening in the DeFi space. So we think that ARC is probably the most appropriate platform for us to be able to build those systems in a way that is as trust minimized as possible.
Hey guys, welcome back to Less Noise, More Signal. Yet another show. This time I want to talk about a little, I would say, technical topic, even though we want to try it not as technical and not be as technical. But for this, I brought on Alex. I originally met Alex in Riga. I don't know, maybe I'll see you this year again in Riga. Are you coming for the next conference that's happening?
I haven't planned yet the schedule for, I guess, this part of the year. I will try, I think, to attend a little less conferences this year and focus on building what we're doing at ARC Labs. So just for context, I am leading like the ecosystem growth at a company called ARC Labs. We're focused on the ARC protocol, which is sort of like a new scaling solution that has come onto the scene in the last couple of years, I would say. And we're kind of like racing towards being able to put out what I think will be the first sort of like public production implementation of the protocol. And so that's coming in the next couple of months. There'll be a lot of very interesting stuff. And we think that it will kind of like bring an interesting narrative to the existing sort of scaling conversation around Bitcoin.
Mm-hmm. Yeah, very interesting. Yeah, so great. Thank you already for the quick introduction. So it's very interesting, because you've struck me as somebody who has a decent understanding or a great understanding of what's going on in terms of like all the technicalities in terms of scaling and whatnot. So that's why I wanted to bring you on. I mean, again, I'm a total layman. I guess some of the people in my audience as well, but I'm sort of interested as well on what's happening, because I think that's just going to define where Bitcoin is going mid to long term. What is sort of possible to do with Bitcoin sort of also defines its fate in terms of how we're going to use it further down the road, So yeah, I'd like to really talk about this, and I think you also have some thorny takes on Ethereum. At least that's what I can see on X, and I want to talk about it all. But maybe to start off, if we could sort of lay the foundations, So I mean, blockchains, they don't scale naturally. That's probably something a lot of people know by now. And I think also with Bitcoin, there's sort of these inherent limits to base layer scalability, so to say. And I would like to understand, in your words, what is it exactly, that's sort of holding Bitcoin back, and also then probably why it's a good thing that Bitcoin is not scalable on a base layer sort of the dimension.
Sure. I mean, it's funny because, you know, we went through sort of an episode a couple of years ago. It's almost been 10 years now in Bitcoin, which was called the sort of like block size wars, which very much kind of like revolved around this idea of how do you scale a blockchain. And 10 years later, funny enough, if you look at the current state of the industry outside of Bitcoin, there's still very much people that are hanging on to this idea that you can actually scale blockchains naturally at the base layer. So that's probably a different conversation. But what I'm referring to here is the likes of like Solana and maybe even Ethereum to some extent, although they have kind of like different models. But fundamentally, it all comes down to really like what is the solution that Satoshi came up with when trying to design this decentralized system, this decentralized monetary network, right? And the core of it revolves around this idea that individual node operators, so the people that effectively store the record of transactions of Bitcoin units of every Bitcoin in existence, to be able to track the monetary base and therefore come to sort of like this global consensus, right, around who effectively own what part of the money supply. Who owns all of the UTXOs and all of the Bitcoins? And to be able to do that, well, you need to create massive redundancy, right, across, again, this sort of like global network, therefore allowing essentially as many people as possible to keep this record and be able to validate their interaction with the Bitcoin network so that they don't have to trust a central party, a trusted third party to be able to evaluate, what is the status of the Bitcoins that they own, but also kind of like the status of the network as a whole. And to be able to sort of like carry all of that history at an individual level, obviously implies a certain amount of resources, right? The Bitcoin blockchain nowadays has grown to be sort of like gigabytes and of data, and this is all data that people need to store on their computer or whatever device that they can like run their node operation on. Obviously, there's some bandwidth implication as well because when you're, receiving all of the new Bitcoin blocks that are being mined, you need to process and validate all of that. And so historically, Bitcoin has made it sort of like a conscious effort to keep this data requirement very low, so as to make it so that the average person running their own personal computer is able to therefore run a personal Bitcoin, right?
Yeah.
Um,
Is it maybe just is this
yep,
also where like the block size, and the block time, like these two terms, are usually thrown around when you talk about scalability, and then you say like, okay, as a general understanding, you could just increase the block size, so you have more sort of transactions that you can fit into a block because it's bigger, gigabytes, whatever you could use
yep.
there. And then also in terms of block time, if we sort of, because Bitcoin has a block time of 10 minutes on average, if we could sort of decrease this as well, it would make for faster transactions. So that's sometimes what I'm hearing, but there's probably a problem, and it alludes to what you sort of were talking about, right?
Exactly. Exactly. I mean, one of the most conscious decision, again, of being able to keep this data requirement as minimal as possible was this sort of like block size debate that played out in the last, almost again 10 years ago from, I would say, 2015 to 2017. And it all revolved around this idea that when blocks are added to the Bitcoin blockchain, all of these blocks have a fixed amount of data. Historically, it had been 1 megabyte of data. So there's a sort of like linear limit, right, to the size of how much the Bitcoin blockchain could grow over time. And then came a conversation eventually around, well, obviously, given this data limit in every single Bitcoin block, This implies that there's also a transaction limit for every single Bitcoin block, because every single transaction carries its own sort of like amount of data, and putting it all together, you can only fill up blocks up to a certain extent with a certain number of transactions. And so as Bitcoin was kind of like getting more popular, people realized that this might involve some kind of like trade-off, and this might, well, at least some people were concerned that this might slow down the growth of Bitcoin's adoption by limiting the throughput and the ability for Bitcoin to serve so like as a medium of exchange, because as throughput is limited and demand increases, what happens is this directly reflects into transaction fee becoming more and more expensive. So like the adoption started picking up, transaction fees, sort of like mildly started creeping up as well. A bit of a debate and a conversation came about in the industry about how are we going to fit the next billion users? Because at that time, it was still like 2015. Like there was a small fraction of even today's users involved with Bitcoin, but we could clearly see, right, that the actual model of having everyone transacting on the base layer did not scale. So what were we going to do to allow as many people as possible to use Bitcoin? Well, one option was to increase the block size and double the block size. You can make it 10x. You could grow it as big as you like. But again, the consequences of that is if you make a single block, for example, 1 gigabyte, and therefore, you're going to have quite a large amount of latitude in terms of how much transaction you're going to fit into every block, because those blocks are coming every 10 minutes, right? But the issue there is if you're adding 1 gigabyte of block of data to the Bitcoin blockchain every 10 minutes, then this starts to compound very rapidly. And the issue there is that eventually the data requirement might make it so that it becomes prohibitive for the average person to be able to even operate a node. And even worse, that I would argue even worse than the average person, because the risk scenario here really is that as the block size grows, if we were to speculate that the blocks become extremely big and the blockchain becomes massive, it requires massive amount of data processing, it could come to a point where it would be almost impossible for a new user, even with sufficient amount of resources, to come in and kind of like sync up. Because what happens when you join the network and you want to operate a node is you need to ask all of the other nodes, okay, send me all of the data so I can catch up to the current state of the Bitcoin blockchain. And when you're talking about terabytes and terabytes of data, it's not only the fact of downloading that data, it's the fact of processing, verifying the signature, computationally expensive to a certain extent. Anyways, all making it so that, the concern is that you're effectively hurting the decentralization of Bitcoin if you're increasing the data requirement. So the conscious decision was made to not really, we did actually increase the size of the Bitcoin blocks, made it to all the way up to 4 megabytes. But there clearly was a decision that was taken that increasing the Bitcoin block size was not the solution to be able to bring more people into this ecosystem, that we would need to build, different layers of abstraction that would ideally preserve the security guarantees of Bitcoin without conceding some of its decentralization and security properties.
This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL. Yes, exactly. Yeah. So I want to talk about these sort of layers, that you were talking about, the layers of abstraction. But maybe one question I wanna jump in with here is sort of, some people might be who might not be that technical might be saying, okay, why is it important to sort of keep decentralization with Bitcoin, and especially like why is it important that everyone can sort of run their full node, and I think this is still something that's it was probably clear to us and people who were really fighting the block size war. But I think nowadays there's more and more people who don't really get why this is important. But I think it is because it then links or relates back to the discussion I think we're currently having with BlackRock, and like the big institutions buying up all the Bitcoin and potentially like maliciously forking it and stuff. And I think that's why you want to, at least as I understand it from, again, it's a really basic understanding of the technicalities here, but that's why you want to have it as good or as easy as possible to run a node for everyone, right? Can you maybe flesh this out again, and
Yeah.
especially to the discussion with BlackRock and the big institutions that's sort of gobbling up all the Bitcoin?
Yeah, obviously, it's a big topic of conversation, and for the right reasons, obviously, nowadays. I mean, at the end of the day, it's all revolves around this idea that Bitcoin is a system of rules, right? And obviously, and one of the most like preeminent rule in the Bitcoin system is its limited supply. It's a 21 million supply limit, and this rule is only strictly enforced via this notion of consensus in Bitcoin, right? And this notion of consensus is quite an abstract one, because, again, it is not strictly defined by who is operating this sort of like Bitcoin node software. Anyone can trivially install Bitcoin node software, and even I myself could trivially like deploy 1,000 different node instances, if you will, right, in the cloud using Amazon and things like that. And so there's this idea that there needs to be sort of like economic weight that's attached to the individuals that control, those nodes, right? You want to make it so that um, there's a balance of power in the system, and you want that balance of power to be as distributed as possible. So obviously, you know, one argument that I actually often make is that even though the average person might be able to run their own node, if they have only a couple of dollars to their name, then they're not necessarily the ones that are, in a way, most important to enforcing the consensus rules of Bitcoin, right? The ones that are most important to enforce the consensus rules of Bitcoin are really the ones that have the most skin in the game. But the fact is also that, skin in the game is capital markets are volatile. Someone else can come in tomorrow that buys more Bitcoin than the previous person that had more Bitcoin. And therefore you need to make it accessible for these people to be able to voluntarily contribute to the consensus of the network. And ideally, you want to have that consensus be as distributed as possible so that no single party can start leading the network into a situation where they start controlling this consensus by having, it would not only require them controlling the majority of the nodes on the network. Certainly, that would also require them controlling a significant portion of the capital on the network. That is something that's probably more difficult to do because naturally, capital markets tend to distribute in and of themselves. Like there's not really, especially when we're talking about global markets, it would be kind of like far-fetched to say that there's some sort of giant capital monopoly that emerged. Certainly, there are extremely powerful entities in every capital market that have, more sway than others. But, we don't really exactly live in a sort of like unipolar world. So as long as we have this multipolarity of capital entities that have each their own incentive to make it so that the rules of the Bitcoin system remain as they are, because increasing, for example, the supply, inflating the supply of of Bitcoin is not going to work to their advantage. Then you create so like this game theory, right? This sort of like Nash equilibrium, which makes it so that the incentive of everyone is just to leave the rules as the system as is, because it benefits them financially, literally.
Mm. Okay, but yeah, because the question ultimately would be sort of, does it come down to game theory only then, in the end? Because like, as far as I'm understanding you, and this is also what I want to get into is like, the way we're scaling Bitcoin today, we could at some point enable like, yeah, big capital markets, sort of UTXO based ones, that are sort of on Bitcoin. And I want to talk about what this means, but this then also means, yeah, like there could be these incentives could be changing, and sort of, yeah, Bitcoin could actually, there's the risk of Bitcoin being co-opted at some point. And do you see that risk, or is it still sort of, still out there, or can we prevent it, after all? If we go back to this, like, try to keep it as decentralized, everyone should run their own node, especially also like real Bitcoiners maybe understand the sort of, positive of decentralization and what comes with it. So, what's your take there?
I mean, I think I take a bit of a different stance than most people on that notion, and mainly because I believe that the game theory is pretty sound in that regard, and it comes from the fact that, again, although it is true that there are the rocks of the world that control, um, gigantic amount of resources and capital, they're still playing on a global field, right? Where there are, you know, somewhat similar entities in places like China, or maybe not independently entities in China, but perhaps entities in China with entities in Russia. There's kind of like always, to me, it's kind of like a two-player game. If you can kind of like boil it down to a two-player game, in the sense that there's kind of like this East-West dynamic, this sort of like United States, China dynamic, and it seems very far-fetched to me to imagine a scenario where, um, you know, the United States, for example, through BlackRock and other entities, decide that they want to stake a claim in onto Bitcoin, right? And say that, okay, well, we want to control the network for whatever reason, however they might attempt to control the network. The nature of the network is such that, clearly the reason why they would want to do that is clearly they see they see some benefits to the Bitcoin network, right? And therefore, those same benefits apply to every other player in the game. And so it's very unlikely that other parties that are not the United States will agree to the United States kind of laying that claim of control over Bitcoin. And I see a similar dynamic actually emerging in the field of AI, right? Where it's such a powerful, so like all encompassing technology that you're never going to have, you it's very unlikely that a single player is able to dominate in that way. Because again, I feel like the game theory of Bitcoin not only applies at the kind of like at the software level, but really comes down to macroeconomic economics, and this idea that the world is multipolar. And at the end of the day, we've never kind of like, except if you go back perhaps to like, hundreds and hundreds of years ago to the Roman Empire, you've never really had like this sole entity that controls all of the resources. So I'm not as worried about this as I think a lot of people are. But certainly there's cause for um, vigilance, I would say, in terms of avoiding, because what you want to have is, even large and well capitalized and resourceful players, you want to avoid a situation where all of them pool their capital into custodians and things like this, where the sort of blacktail sorry, the kind of like black swan event of potentially all of these bitcoins getting stolen, for example, or some bug happens where all of these entities lose their Bitcoin, then it would be possible for them to kind of like start lobbying against some sort of like change to the system that will allow them um, to retrieve those assets and therefore kind of like compromise the neutrality of the network.
Mm-hmm. Yes, I understand. Okay, I see. Yeah, that's a really interesting discussion after all, because like it's been heating up with this sort of reality that the U.S. has now also deemed Bitcoin a strategic asset, and obviously to me, like the world is always full of trade-offs. There's obviously benefits to this, and there's going to be a lot of benefits, probably most likely price, and that's what a lot of people are rooting for. But then, I mean, again, the trade-offs might be if the U.S. considers Bitcoin strategic, and then they might have an interest, and then that's sort of what has me worried. But at the same time, you're correct. The world is so Byzantine, so complex, and it's probably not that easy for the U.S. than just to take influence because there's other players. Maybe that romantic picture of like we the plebs, are going like every single one of us like as an army of the free hunters, against the big players. That may be a little bit too romantic, but as you said, there might be other institutions that side with us then, and then sort of also economic players and geopolitical players. So it's just going to be in the end more complicated and complex as we ever imagined. Probably that's probably it.
Yeah, but well, I mean, very quickly on that note, I mean, you can take what's going to happen. What I feel is going to happen, and what although there is this sort of like idea that okay, this giant kind of like has arrived on the scene, which was inevitable, by the way. I mean, if you regard Bitcoin as if you're a Bitcoiner and you regard Bitcoin as kind of like this pristine asset, it only makes sense that one of the most powerful entity in the world is going to wake up to the same idea at one point and realize that they need so like a seat at that table. But what I'm seeing with kind of like the announcement of these strategic reserves and all of that is that at the same time it also signals it creates a signal for smaller countries, right? And what's interesting is smaller countries sort of like inherently have the ability to move more quickly, right? And so you can look at the really like a place like Bhutan, right, which is like the smallest country, and they didn't wait for the U.S. to like announce a strategic reserve. They've been mining Bitcoin for the last couple of years already, and they have like put together a reserve of their own that obviously proportionally you can debate whether or not, but it to me it's not clear that the U.S. government, although with all their might and all their resource, is going to easily be able to kind of like dominate that game if they really intend to start playing it, because it's a signal to ever if they really, and for now we're only talking about executive orders, so you can clearly see that like the market, I wouldn't say it's called their bluff, but it's kind of like tempered the expectations in the sense that like it's until the point where they actually start buying openly on the market, it's all kind of like noise to a certain extent. But if they start doing this, then obviously it leads every other country in the world to feel like they have to play over in there as well. And it kind of like it becomes a bit of a weird race, and it's not clear that like necessarily the US ends up the winner there.
Yeah. No, that's for sure. Very interesting. I mean, one thing as a Bitcoiner that gives me hope, is sort of also the things that you guys are building on, So like the really like, because I feel like as somebody like me, who's really into Bitcoin, but sort of is not technically well versed enough to maybe, especially if you want to go beyond just hodling Bitcoin, you want to do some other stuff with your Bitcoin, and then usually you end up using some custodial solution because the other thing is just too complicated and is not ready, And I think if we are moving into this direction, and as I understand you, and that's also what I want to talk about now in the reminder of the rest of this interview, then obviously, there's more possibilities to sort of go non-custodially. But I mean, before maybe really talking about this, I want to come back to this modularity question, scaling in layers, because I feel like especially in Bitcoin and Ethereum land, there seems to be consensus that this is the way to go. Like base layer scalability is sort of limited, and that's why you have to scale in layers. But I think you are still a critic of how the Ethereum folks, how they are doing it, and what are they, what are, what are they getting wrong, so to say?
Yeah. Right. Well, definitely. I mean, again, I think indeed Ethereum and Bitcoin have this notion that everything should scale in a way that, I mean, in a layered way. I would argue that Ethereum is actually kind of like reversing track and perhaps even trying to scale everything at the base layer at the moment. But putting that aside, the major difference here is really that taking the Lightning Network, right, as the primary example of how Bitcoin is trying to scale in a layered way. The Lightning Network is unique because it is sort of like a local consensus mechanism, right? What the Lightning Network is an agreement, for example, between me and you that we're going to sort of like put funds into this bucket and we're going to sort of like keep track only the two of us of who owns those funds. And eventually, if we want to, we're going to settle the balance of that bucket on chain, right? And what the Lightning Network allows is actually it creates a network between those relationships of two entities. So therefore, me and you and other people are able to use those channels, right, that we open, those kind of like buckets where we collectively pool money. So what the Lightning Network allows is to connect all of those different channels in a massive graph that is very much kind of like akin to the internet, really. What I've been saying all along, very much lately, actually, and even in Riga when we first met, was that there was this notion always that Bitcoin is the internet of money, but really Lightning is the internet of money because Lightning, just like the internet, has all of these concepts of routing, you know, of this massively distributed system that uses this architecture where you can have local consensus, local agreement on who owns what resources, but you can also communicate and project that and send that capital outwards to different, parts of this, so like massive global graph, right? And Lightning is unique really because it is the only system in the crypto industry that allows for instant settlement of capital in a way that does not require any trust at all. Um, and that is a very, very powerful property that I think still to this day is not fully appreciated for various reasons. Because Lightning has faced some headwinds, obviously. Um,
Yeah.
but
But I mean,
go ahead.
if I want to boil it down to like this archetypical distinction, sort of, between
Yep.
Ethereum scaling and Bitcoin scaling, could we also say it's sort of an off-chain layer, which is Lightning, vis-a-vis like these on-chain execution layers, that the Ethereum with the layer twos. But then again, one thing is still on chain, so to say. It's just a different, more centralized blockchain, so to say, that is sort of trying to scale that stuff. Whereas with Lightning, it's really off chain, global, not a global consensus, but as you said, like a local consensus. So is that like a fair distinction to make?
I mean, fundamentally, both systems, if we want to contrast, the direction that Ethereum has taken is the systems that they're building is also to be considered off the Ethereum main chain, right? So it's also off chain. The difference is that they have opted to just replicate global consensus. If it effectively created adjacent or like parallel global consensus systems, mainly what those rollups are, which requires again tracking so like global balances across every single users of that system, meaning that fundamentally they haven't really solved this notion of scaling the layer one, right? They've just exported portions, literally they, and what that's one of the issues, they fragmented the existing network on layer one into different sort of like off-chain layers, and all of these off-chain layers just find themselves having to communicate and kind of like bridge between one layer and another in a way that is not natively interoperable, and therefore it requires users of Ethereum, if they want to move from the Ethereum chain to those roll-ups or these other layers, to use different flavors of bridges and different technologies that are not always trust minimized, that carry inherent risk, that sometimes are fully custodial. And so this has led to kind of like all sorts of incidents in the Ethereum ecosystems of kind of like massive hacks where the funds that are deposited in those bridge get hacked and whatnot. But this is a security concern that's a little bit different than the actual scaling concern, which is, you know, the contrast here really indeed is that Lightning operates on a purely so like local consensus base. So I don't have to keep track. No one has to keep track of the balances of everyone in the system. I keep track of my own channels, and you do the same with yours. And we have this massive architecture that allows us in a native way to interoperate with everyone else within that network and kind of like send money around. Obviously, there are other differences. Structurally, Lightning is very much solely focused on transfers of money, whereas those Ethereum layers also carry so like um the ability to create so like different execution layers, and therefore more so like powerful and versatile um contracts, if you will.
I mean, yeah, the thing that were explaining with the local consensus, but I feel this feels to me as a layman again really to be a right innovation if you get it right, or like a real innovation, so to say, because like when I try to compare it just with my basic knowledge to how traditional scaling solutions in terms of finance work, like obviously I mean, even in the traditional world of finance, it's scaled through layers. You have the central banking layer, which is like the base layer. Then you have the banks, who come in. In the end, the ones, the layers that we sort of are transacting on are then like all the payment processors, like the card issuers, all these sort of entities. But they're always sort of global consensus as well, because like it's one centralized system that keeps track of everything, and then like the local consensus we've never really had, so to say, or is that not a fair um assumption,
I
so to
mean,
say?
ultimately, the architecture is similar. The only issue with the fiat system is it indeed ultimately really relies on very so like trusted entities to coordinate the actions of all of these lower level local um, financial systems, right? And so you always kind of like have this Swift layer, right? That like allows all of these. And so the issue there is that although you can operate locally within your own economy, whenever the local economy has to tap into the global economy, they have to rely on these trusted third parties, and therefore can be censored, seized, or there's some kind of like permission that needs to be asked here. With the Lightning Network, it's quite different because there's no central authority kind of like creating this connection between every node, local nodes in the network. The architecture is very very similar to the internet, really, and therefore it's not fully peer to peer in the same way that the internet is not fully peer to peer. The internet originally was planned to be fully peer to peer, right? And so you kind of like you can see those old internet graphs of like when there used to be maybe like say 50 to 100 entities on the internet, universities and whatnot, and they were all interconnected with one another, right? So you would have a direct connection with every single node on the network. Obviously, they quickly realized that such a setup just simply does not scale, right? And so what happened was they introduced all of these ideas of like, internet service providers, right? So within your own local network, thousands, millions of people would connect to the local internet service provider, and this internet service provider would kind of like serve as a gateway to the global network. Right. And so Lightning is also kind of like evolving in similar ways. Uh, but this feels like the only way that those systems can truly scale without creating this, this baggage of data. When you have a global consensus system, the issue that, systems again like Ethereum are having right now is you find yourself having to have this crucial data that everyone kind of like needs to own to make sure that their share of the system is not kind of like being infringed upon. And so where do you put that data? And Ethereum is kind of like become to a point where this data is kind of like being passed around from one layer to another, trying to become abstracted from the user, but ultimately it's turning into kind of like that toxic waste that like gets stuffed somewhere where they pretend that they have some sort of like incentive driven network. It's kind of like becomes turtles all the way down. No one really knows.
Yeah, it's like nuclear waste, where to store it in the end, and then it's just getting passed around like a hot
Well, what
potato.
happens what happens is the further that data is stored away from the base layer onto different layers, then the further trust trade-offs are being made, right? Because even if you take Ethereum, clearly the most trustless like layer of Ethereum is its base layer. It's its most decentralized. It's the one that has the most, but even Ethereum themselves, although again, it's that notion is kind of like being challenged right now, but they're like, well, we cannot possibly put all of that data on the main layer because then it would be detrimental to our decentralization. So let's move it somewhere else. But by moving it somewhere else, that data ends up somewhere where only a smaller and smaller portion of people control and is able to give access to it, and therefore leads to just a more permission system.
Yes, I see. No, for sure. But I want to come back to the Lightning Network as well, because like
Sure.
what you've been describing, with these like sort of hubs that are also emerging on the Lightning Network, and I feel like it's just nature unfolding there. It's just economical for us to sort of have a sort of to some extent some sort of centralization. But then obviously a lot of critics jump in right here and they're saying then, okay, the Lightning Network, it's also centralizing, and why isn't it then different to or why should it be different after all to the traditional financial system? So what is your argument there? I guess there is a distinctive difference after all, right? Even though we see this liquidity hub and all these things emerging.
Well, I mean, the fundamental difference is that the Lightning Network is a permissionless network, right? And so, again, as I was saying, the Lightning Network did also, just like the internet, evolved in the way that individual users, so like the end users, don't necessarily have those channel relationships with every other users on the network, right? That would be extremely inefficient. And therefore, the current architecture kind of like most of the time will lead users to open a channel with what is called the Lightning Service Provider. And just in the same way that in the internet service provider connects the internet user to the global network, the Lightning Service Provider just connects the end users to the rest of the rest of the Lightning network. Those Lightning Service Provider do not there's no trust required for the users to do business with them. They only strictly open a Lightning channel. It's just as trust minimized as any other Lightning channel. Obviously, the difference is that you need to find a Lightning service provider that's going to be willing to do business with you. So perhaps this is where some of the arguments come in of, okay, well, perhaps those Lightning service providers can therefore be targeted by the state as, running this sort of money transmitting business, this sort of like intermediary, because they do indeed like serve as an intermediary function between the end users and the rest of the network. I think the major difference again is the notion that, well, I don't have to. ask permission if I want to become a Lightning service provider. All of that I need is so like technical proficiency to be able to operate a Lightning node and create connections across the Lightning network. And I need capital as well. And, Bitcoin capital again is permissionless. So what happens therefore is that, unlike even just internet service providers, you need physical infrastructure, you need permits, you need red tape and government approvals and all of that stuff, right? If you want to become a Lightning service provider, you just run some software, you put some Bitcoins on that software, and it's. I'm not trying to say that it's kind of like a trivial matter. It's becoming increasingly professionalized for the right reason because this is a specialized business. There's some sort of like sense of capital efficiency in terms of who they open channels with and how they manage the balance of liquidity across all of that system, but it's open to anyone else, anyone globally, right? And so in the same way that, again, with my internet service providers, I'm kind of confined to doing business with, well, I guess that's not so true with Starlink anymore, but, before Starlink, I was kind of like confined to doing business with someone that's within my, so like geographical vicinity, right? Because they have the physical infrastructure. With Lightning, I can do business with a Lightning service provider that's halfway across the world, right? And it doesn't make a difference to me. So again, the permissionless aspect is the major breakthrough and the major difference here.
Yes. Okay, I see. Interesting. What I've been wondering as well is sort of like the Lightning Network has been grappling with quite a few challenges. Like especially as we said, the liquidity thing is something that has come up every now and then. I mean, I heard about the problems of having to be online to receive a payment and all these different types of challenges that are around. So for somebody like me who has not been following it that closely, have some of these challenges been overcome, or where are we when it comes to these challenges?
I mean, there has been tremendous progress in terms of usability around Lightning and architecture and so like infrastructure around Lightning. For those that are curious, there's a report, for like a state of Lightning report that was created, that was put out just a month or two ago by financial or Bitcoin U.S. Bitcoin exchange River. So that's worth checking out because it gives quite some perspective around the scale of the Lightning Network, like the volume that goes through all of it and the entities that are involved. But generally speaking, indeed, it is the case that um, the so like early promises around Lightning and this notion that it would create kind of like this perfectly frictionless um, payment layer that would be easily accessible to retail users um, is has taken a little more time, I think, to like pan out. And one of the largest problem is indeed kind of like what people have been calling this sort of like last mile problem. And this idea that how do you actually serve those wallet users that do not want or need to have this ability to manage Lightning channels, right? Because obviously if we're Bitcoiners and whatnot, I mean, this is perhaps something that's interesting to us and we're going to be willing to go to the lengths of understanding all of this. But this is obviously not a model that scales to the global population. Someone needs to be able to, download a Bitcoin wallet and not have a prompt that tells them that for them to be able to receive money, they need to purchase liquidity on the Lightning network, right? Which is very much how Lightning works. Unfortunately, it's a liquidity network. And therefore, you need progress in terms of being able to abstract all those concepts away from the end users. And there's different sets of ideas about how to be able to do this. But even putting aside, so like this UX challenge, one of the realizations that I've had personally, and I think not a lot of people appreciate enough, is that fundamentally the Lightning Network is also kind of like a bidirectional system, right? This idea that we're opening a channel, for example, between me and you, a lightning channel between me and you, is that we expect to be sending each other payments at some sort of like regular interval, right? And the way that the capital is currently flowing in the Lightning Network is not exactly, is not direct exactly a bidirectional flow, right? Most of the time, what will happen is that you have this one merchant, for example, that is receiving incoming inbound payments from hundreds, thousands of users, and it's a one-way street, right? If I buy something on Amazon, I'm not receiving money from Amazon, right? So it doesn't make sense for me to have to have a channel with Amazon, right? And what this has created is some sort of like, I would say, imbalance in sort of like the flow of the capital on Lightning. And this imbalance unfortunately requires Lightning operators and the people that are managing this infrastructure to kind of like have to rebalance the flow of capital within that network. That those rebalancing operation involve on-chain operation, involve Bitcoin main layer operation, and obviously, you know, certainly right now the fees on Bitcoin are pretty cheap, but we can expect them to rise in the future, and they have in the past. And when you're starting to rely on-chain operation to rebalance, all of this liquidity flow within your own local network, then you kind of like defeating the purpose of Lightning, right? Because therefore you kind of like have to pay the cost of and that cost of rebalancing necessarily has an impact on the overall Lightning network, right? So it kind of like creates, I would say, inefficiencies. So like leaks of value within the Lightning network, and so there's kind of like this entire architectural conversation that I think needs to happen. But again, there's great progress being made by many different Lightning implementations in terms of solving those problems, and I'm very 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 positive that we will be able to connect users to the Lightning Network in ways that perhaps were not the ones that were previously thought of. Uh, but Lightning will ultimately serve as kind of like this overarching layer that serves all of these different systems that we come up with to serve, the retail end users.
Mm. Yeah, amazing to hear. Good, that's actually really good to hear. But I mean, we also want to link to this Rivers report and the show notes. But I mean, we're 50 minutes in and we haven't talked about ARC. So that's why I want to bring in ARC now. And really ask you, what is ARC? How does it relate to the Lightning Network? Is it sort of on top of it? Is it another protocol altogether? Does it supplant it, or yeah, where does it come in? Can you fill us in?
Absolutely. This is something that even ourselves working on ARC have almost kind of like been struggling in a way for the last couple of years of how exactly do we define this, what is literally like a new invention, and how do we connect it to this existing architecture of Bitcoin. So I will say to start off that ARC is compatible with Lightning. There's actually kind of like a very great synergy between both systems. But ARC is a little more, I would say, closer to the Bitcoin main chain in some ways than Lightning is. What I mean by that is really that ARC is sort of like a generalized protocol to allow for transaction batching. And what I mean by this is rather simple, actually. So some people that might be familiar with Bitcoin would might have heard about transaction batching in the notion that, for example, when Bitcoin exchanges,
Right?
exactly,
Exactly. Exchanges do that.
exactly,
Yeah.
exchanges actually do transaction batching nowadays, and what they do is that when they have requests from, say, 50 users to withdraw their money from the exchange, they create a single transaction, and within that single transaction, they create 50 different outputs, right? They assign to within that transaction 50 different beneficiary, and everyone, therefore, within a single transaction gets their money. This is already much more efficient than creating 50 different Bitcoin transaction that each goes to every single user, right? There's significant cost saving uh, from that perspective.
And that means you can
Right.
already do this with on-chain Bitcoin today, and you don't need ARC for this, right? That's really happening on the base layer, right?
That is correct. That is correct. That's just creating a normal Bitcoin transaction, and when creating a normal Bitcoin transaction, you can decide what Bitcoin are you going to use as an input to the transaction, and decide what addresses you're going to send those Bitcoins, and you can totally send to different addresses within the same transaction. Um, but this is kind of like the version one of transaction batching. Arc kind of like brings us in, so like the future of transaction batching, which is instead of creating 50 different outputs within a single Bitcoin transaction to allocate the funds to their respective beneficiary, we're actually going to use a single output, so a single Bitcoin UTXO, and we're going to make it so that this single Bitcoin UTXO is spendable by each 50 beneficiary according to the amount that is allocated to them, right? So if we scale that down to 5 people, and I have a single Bitcoin output in a transaction, a single Bitcoin output with say 5 Bitcoin, then we're going to make it so that that output can be spent by each 5 users, and all of them have 1 Bitcoin. And so we use some of the latest technology that has been brought into Bitcoin in the last decade, namely the soft fork the Taproot soft fork, and so like all kinds of new generations of multisig that allows us basically to concatenate, to aggregate beneficiaries of a single output and distribute that to different people, giving them the unilateral spending rights to a single Bitcoin output on chain. And therefore we get massive scalability gains, right? Because instead of, again, we already gaining efficiency when we're doing regular transaction batching, one transaction, 50 outputs. That's already coming back to our conversation about block space. That already takes a lot less space into a block than 50 different transactions. What we're doing then with Arc is literally one transaction, one output. So therefore, you can have 50 users owning what is effectively shares of a single output, and all of that you've spent in terms of space in the Bitcoin block is one transaction.
Right. I mean, maybe a really rookie and almost blasphemic or blasphemy question here, is sort of, does this mean ARC is just sort of a better solution for exchanges, and it's just going to be exchanges who are going to be more efficient in doing like transaction batching, or is there more to it? Sort of, no, it's not only going to be exchanges who are
Right.
going to be using ARC, but you can build other stuff on top of it that's not relevant to exchanges.
I mean, that's an excellent question. And no, absolutely. I mean, it's beneficial to all, because what this allows is that you allow any entity to serve as an ARC operator and to offer a transaction batching service. Therefore, I can go to an ARC operator, deposit my Bitcoin, and what they're going to do is they're going to include the Bitcoins that I send them into an ARC transaction batch, right? And so there's going to be a single output on the Bitcoin block in a Bitcoin block that is going to contain, say, 10 Bitcoins, and one of those Bitcoins, a share of that Bitcoin is going to belong to me, and I'm going to be able to spend it whenever I want. Now, the cool thing, and so like what ties this all together with ARC, is this idea that we can actually spend those Bitcoins that we have in those transaction batch and basically move them from one batch to another, right? So if I want to spend the Bitcoin that I put into an ARC transaction batch, and I don't want to send it to you, I don't want to send it on chain again, right? Because therefore it kind of defeats the purpose, right? Therefore you're receiving your own UTXO, and we're kind of like back to the same model of one recipient, one transaction, which we know does not scale. So what we're going to do is we're actually going to tell the ARC server, hey, I want to send a Bitcoin to Pascal. Can you include a Bitcoin for Pascal in my next batch? And the server is going to do this. And we use kind of like a neat construction that we call the connector output. And I'm not going to go into details, but what this allows is that we don't have to trust the ARC operator. I don't have to trust the ARC operator to give you the Bitcoin in the next batch. I can make it so that the ARC operator only receives the Bitcoin that I send, and is only able to take control of the Bitcoin that I sent if he included a Bitcoin for you in the next batch. So that all of this becomes trustless, and therefore you're able to go from one batch to another with different users being involved, and all of that kind of like remaining in this sort of like off-chain state, right? You have one output on chain, but you have these kind of like nested, what we call virtual UTXOs, right? You have UTXOs on Bitcoin, but when we're creating Bitcoin batches, it creates one UTXO that aggregates a bunch of virtual UTXOs. And those virtual UTXOs are just as good, or almost just as good as Bitcoin UTXOs. You can send them to anyone that you may like. And again, you get massive scaling benefits because every time you're doing a transaction, rather than that transaction directly going on chain and occupying space into a block, it's kind of like aggregated across maybe 1,000 different payments, right? So you get this massively scalable system. The architecture is just a client and a server. So
Yeah.
I deal with an ARC operator. There can be many different ARC operators, and they're all, and thanks to Lightning, all of these different ARC services are kind of like all interoperable with one another. Meaning that if I have some virtual UTXO that exists in a batch creating by ARC operator A, I can send it to someone. If, say for example, if you're dealing with ARC operator B, I can send it to you via the Lightning Network. So the Lightning Network kind of like becomes this settlement system, right? This kind of clearinghouse in between ARC operators. And this is the first step, because we believe that although payments are very interesting, and certainly there's massive benefits to using ARC kind of like as a scaling layer for payments, and as well as facilitating Lightning operations, we think that there's an opportunity for ARC to become a bit more of an execution layer. So this is kind of like you start using ARC as kind of like the settlement system for an additional execution layer. And that execution layer allows you to create sort of the types of contracts that would not be cost effective to create on chain.
Yes.
We know,
Says
because we know that, Bitcoin, although being so like less expressive than other models like Ethereum, Bitcoin does have scripting capabilities, and you're able to create kind of like rudimentary contracts on the Bitcoin blockchain on chain. The problem is you're constrained by space and time, right? You're constrained by the limits of those Bitcoin blocks. What ARC potentially allows you to do is remove those constraints, and therefore execute sort of like higher level contracts that are tied to ARC virtual UTXOs. And eventually, when the user decides that he's participated in some economic activity within the ARC ecosystem, the user can decide to settle all of that into Bitcoin again, if he wants to move funds to cold storage, for example.
Mm. Yes, I see. Okay. But then I think one thing I don't get, or let's put it this way, I get a lot of things, and there's a lot of things that I don't get. But one major thing that just sprung to mind now is sort of, you said, you have a Bitcoin on chain, as I understand, and then you're sort of creating these virtual UTXOs, like virtual Bitcoins. We can put it like this. But then how is Arc not limited by what is sort of pooled on chain at a Arc service provider? Isn't that sort of the limit, or am I something that I don't get here correctly?
How is
Like yeah, like in creating these virtual UTXOs, I felt like this is done by the Arc service provider, and as I understand, some of the Bitcoin will be pooled at this Arc service provider. Like some of the on-chain Bitcoin is sort of sent there.
I would look at it. Yeah, I would not look at it as a pool, because it is not a pool where there is not a single UTXO. There's not a single on-chain transaction that contains the money, the funds of every single users that operates with this Arc service provider. Um, what happens really is that the Arc operator just creates batches, kind of like just regularly at a regular interval, and those batches contains the funds of whoever was involved in this batch at this specific time, uh, this specific place and time, right? So again, if I send you some money on Arc, what's going to happen is once you receive the money, you're going to tell the server, hey, I've received money from Alex. I want to have my virtual UTXO. And you're going to participate in some kind of like signing session. All of that is obviously abstracted through your wallet interface, your wallet application, but you're going to participate in this signing session, and you're going to put your signature on the next transaction batch that the Arc operator is going to create. And by putting your signature on there, you're going to make it so that whatever fraction of that transaction batch belongs to you, you always unilaterally have access to it, right? And so therefore, the money is kind of like spread across different transaction batches. And I'm not limited to sending the money to anyone that deals with this specific Arc operators, right? I can send a virtual UTXO to anyone, even if they don't have as an explicit, so like if even if they don't have a virtual UTXO already, and it's going to be seamless to them. They're not going, as long as they have obviously an Arc compatible wallet. They're not going to necessarily have an existing relationship with this Arc operator.
Yes. Okay. I see. Yes, that's interesting. Well, I mean, being conscious of time, I think I can't go into any more detail here, although I would have a lot of other questions. But I want to ask you this last final question, sort of because you were already hinting at it, like this sort of new architecture that we're talking about here. It can sort of enable what's called Bitcoin native capital markets. I think that's something I read on X feed as well. Concretely speaking, what would be possible then? Do you have any sort of examples that you can share to maybe regular listeners? Yeah, how this could look like in practice?
Absolutely, and I mean, one of the things one of the thing that we're looking at is, for example, how can you leverage what is called discrete log contracts, DLC contracts, within Arc. Right. So there is this notion that is being leveraged right now by different companies that are building, for example, Bitcoin borrowing platform or Bitcoin lending platforms, right? And so one of the main one is being operated out by my good friend Lava, or one of my good friends Shazan at Lava. And what this allows you to do basically, right, is to get a loan based on Bitcoin collateral. And the really innovative thing about it is that it's a completely trust minimized system. meaning that you have an on-chain Bitcoin contract that allows you to deposit money into that contract, and this money into the money in this contract will serve as collateral for a stable coin that is issued to you currently on a different network. But the way that it all works is that if you if you refund your loan for whatever money you borrowed, then it's going to unlock a secret, and you can use that secret to basically withdraw your fund from the on-chain contract. So you have a system that is completely native to Bitcoin, does not require operating with a different sort of blockchain, right? Or a more expressive sort of like smart contract system. But the issue with that system in the long run is obviously, those on-chain contracts are Bitcoin transaction, and therefore there's going to be a limit eventually to, you know, if we're talking about millions of users potentially using the Lava platform, well, you're going to create a scenario where, initiating a loan will be cost prohibitive because it will be tied to a Bitcoin transaction, which could be very expensive. So what we're looking at is how do you lift DLC contracts into the ARC ecosystem, and therefore allows, because keep in mind that the virtual UTXO is exactly the same as a Bitcoin UTXO in the sense that it operates within the same software architecture, and therefore you're able to create the same script primitives that you might want to use on chain. So scaling, Bitcoin borrowing platform is one, opportunity that we're looking at. And we're looking at also kind of like how can you maybe operate derivatives platform on an ARC based system. There is a company that is not operating anymore, a company called 1010 that used to run a sort of like fully um, trust minimize sort of like Bitcoin derivative contracts which you could trade on the application that they developed, and all of that was using DLCs as well as Lightning to a certain extent. And so like they faced some issues with that architecture, and they kind of put the project aside for a moment. But we've looked at this, and we really believe that actually Arc might be the ideal architecture for that type of system to operate. And I think that really, there's a lot of things that are happening in the DeFi space, but a lot of them ultimately boil down to sort of like very simple primitives, escrow contracts, and swap between one financial asset, one financial product to another. And we think that really Arc can serve as a foundation to create what is going to be not necessarily, meme coin trading or so like more extravagant DeFi product, but really come down to the basis of like what do serious financial players want when looking at Bitcoin? Why do serious financial players right now are putting their money into a Bitcoin ETF rather than by buying outright Bitcoin? A lot of them will tell you that it's because their position in the Bitcoin ETF allows them to create, to leverage their position for some sort of like margin plays or whatever. There's some kind of like leverage situation that they can execute, leveraging the infrastructure of existing financial markets. So what if we allow those people to put their Bitcoin into use native Bitcoin and use that to have exposure to an option contract, a derivative contract. If you want to have, some sort of leverage, you shouldn't have to go through the route of fully custodial, ETFs and whatnot, right? You should have the option to do that directly with your Bitcoin. Unfortunately, the options so far that require that offer this type of system all kind of like require bridging. They all kind of require you taking your Bitcoin and putting them into a system where you're going to make very weird opaque, so like trust trade-off. And this, while this might work for uh what is commonly called the degenerates, this is not a sort of like system that is sound enough for professional
Yeah.
financial services to operate within, right? They want to have the confidence that the Bitcoin that they hold is solely theirs and they have unilateral control over them. So we think that ARC is, the probably the most appropriate platform for us to be able to build those systems in a way that that is as trust minimized as possible. Obviously, there's a lot of work ahead of us to make that happen. We're going to be sharing probably. I don't know when this is going to come out, but certainly, within the next month, I would say in April, we're going to be coming out with a lot of news and very exciting updates about this vision that we're creating around ARC. And yeah, we think it's going to be potentially a game changer for the conversation around Bitcoin, and certainly for the conversation around self custody. Because again, this is the point that I've made: is how do you incentivize people to self custody? Is by allowing them to leverage their Bitcoin to be able to participate in financial activity. And that financial activity does not have to be solely making payments, right? And so opening that up to the world of finance, we think is one of the biggest opportunity out there.
Mm. Well, it all sure sounds very exciting. So, Alex, thanks a lot for sharing all the information with us, also for coming on and just spending some time on this. It's just very much appreciated. Yeah, I think we have to bring you back on at some point, but I think we'll call it the quits right now. And thanks. We're going to link to all the stuff that you mentioned, the Rivers paper, sort of the ARC website, and anything else that you maybe can send our way. So very much appreciated. And I think without further ado, have a good one.
Thank you. Thanks for your time. Thanks for the invite. Always a pleasure. Have a good one.
Bye. Thanks, Alex.